Hello everybody, it's time for June 2024 REITs portfolio review, and the last time I did a review was in February this year. It's timely at the halfway mark of 2024 to then do a review of my REITs portfolio and see what happened. But in short, it's just a sea of red, extremely disappointing. Numbers say it all, alright, numbers say it all. So in short, the REITs portfolio is down 12% year to date, inclusive of capital or dividends received. So extremely disappointing. My overall portfolio did slightly better, down 4.5%, and that's because of the stake in UOB, which fortunately I decided to buy earlier this year after selling out of my stake of REIT, which is really an act of blessing from the gods, alright. Having the courage to sell off my REIT at break even and then rotating everything into UOB has made a massive difference in the overall portfolio. And my dividend collected year to date is down 3.6%. I'm not sure if I should be happy or sad. Should I be happy that the dividend cut this year is not to the extent of 12%? Or should I be sad that as a dividend investor, my dividend total dividend collected is not higher? So overall, I think it's okay. At least this dividend total cash I collected as a dividend investor is still not down massively. So it's all about the central banks. So this is what the central banks doing. ECB has cut already, and I think we expect a couple more cuts this year. Unfortunately, nothing seems to matter. After ECB cut rates, I thought REITs with exposure to the European assets would do slightly better. But nonetheless, it doesn't happen. FLCT continues to get the plummet, and IREIT did even worse. So I think Cromwell did better though. So, but unfortunately, I don't have anything in Cromwell. BOE, I think they should be cutting rates later this year because inflation has already fallen back to the 2% target. And BOJ is leaving open the possibility of a rate hike, but it doesn't really matter anymore because if you look at it, it's all about the yen, which has collapsed to a multi-year low of 160. And if BOJ and the government doesn't do anything more, I think we are looking at probably a return to pre-Plaza Accord levels, which will be really disastrous for the entire world because if that happens, then the renminbi will have to go as well because the Chinese need to keep pace with the Japanese and the South Koreans to maintain their competitiveness. And of course, all depends the greenback and what the Fed will do. I'm not sure if they'll cut this year though. I have really no idea, but it's just a complete havoc all over the world. This is the comparison of the various REITs, and you can see everything is down. Ascenders, which is the grandmother of REITs in Singapore, is down 15%. MIT is down 15%. ESR logos is of course no surprise down 15%. Every time you look at ESR logos, it's always down. It's always been down for the past 3 years already. Down, and I think it will continue to go down. Stuff with overseas assets, the CLCT continues to be horror festival with China continuing to be in early signs of a depression. And IREIT of course got plummeted again to 28 cents, 27 cents, 26 cents. Maybe soon it'll be 20 cents and 15 cents with the departure of the main tenant at the Berlin campus. Major repositioning work will be in the works, and I'm not sure what they're gonna do to fund the expenditure. So let's see what happens. But I was really happy that I got rid of a major stake in IREIT earlier this year and rotated the capital into UOB. That was really a blessing in disguise. Other REITs, some REITs did better, but nonetheless, everything is still down. FEHT is down 7%. A bit of good news nowadays with potential redevelopments, I suppose. Well, rumors and speculation of the redevelopment of the plots around the Orchard Parade Hotel. And CICT, quite steady actually, down 3%. I was quite surprised. I thought it would be down more actually. FCT was also pretty well. Star Hill Global has been pretty stable as well. But if you look at the other cousin, the cousin of FCT, FLCT, it has been a complete horror festival as well, down 16%. I thought with ECB cutting rates, this would do better, but nonetheless, nobody really cares and it's now the same. What's interesting is that all the logistic REITs, which has been quite stable for the past 2 years, are all taking beating nowadays. Ascenders is down, MIT is down, ESR is down, FLCT is down. So the logistics REITs, logistics and industrial REITs, all taking out the chin now, all down 15%. So it's a thematic sell actually. Some funds are just aggressively selling off all industrial REITs. So I think that's what's the conclusion. Alright, and this year I think the conclusion is that if you don't have banks, you don't have the S&P 500, you'll be looking at a really small year. DBS, UOB, OCBC down all up by what 10+%. With DBS, of course, the big brother leading the way up 18%, and S&P 500 is also up 15%. But nonetheless, if you look at the components of S&P 500, if you take out the Magnificent Seven, including Nvidia, then the rest of the portfolios the rest of the index is actually not doing that well. And I see early signs of weakness emerging in the consumer discretionaries. And you see people like McDonald's and stuff returning to the value meals. So they are not really in a position to raise prices anymore. So I think inflation in the US is getting a bit under control. But nonetheless, with the horrible fiscal policies of Biden, and I seriously hope that he loses the election. Unfortunately, I don't think Donald Trump will be much better. So I'm really quite pessimistic about the fiscal path of the US going forward. So this is my portfolio and the position and the weighting that I had in February 24. And you all should know by my update just now that this whole portfolio is now at 12%. So this is the new weighting. The first thing that I did and the only thing I did was to sell half of my Capital Land India Trust at 1.04. So this stuff I bought during the rights issue that I had last year, and after capital dividends and stuff, this position was still positive at 1.04. So I halved the position and rotated the capital elsewhere because I just realized that even if they cut rates, it'll be too late already. So I'm not in a good position to hold even more REITs in my portfolio. So it's pretty much sell anything that is profitable for me and see what happens. So I sold half of the clean position at 1.04, and this is the remaining position weightage of the new portfolio. So FEHT has risen, which is quite nice. AIMS is quite steady as well. Cleans, of course, I've sold the half of the position, so now it's 4.5%. ESR is kind of the same, but of course it has fallen as well. MIT is roughly the same. Star Hill is roughly the same. I didn't do anything with the rest of the portfolio though. The only thing that I sold was cleans. So the changes in the percentage was just a function of the numerator divided by a lower denominator. So CLCT, of course, is now also 10.8%. Quite surprised, because I thought it will fall even more. But I guess it was because CLCT has already hit a low in earlier this year, and it's just kind of like hovering at the recent lows. FLCT is 10% of a portfolio as well. Escort 9%, and iREIT has of course taken it on the chin and is now only 1.5% of portfolio. This stuff has really collapsed big time. Only thing fortunate about the iREIT is that I had a decision earlier this year to cut the position massively and rotate into UOB. You cannot imagine it, but this position was around 12 or 13% of my portfolio earlier this year. It was really a blessing that I sold so much of it earlier. So that's one thing that is quite comforting, that I think I progressed as an investor. Nowadays, if I see something is wrong, I'll just cut loss immediately and rotate. It's much better to recognize your losses and move on rather than to look at it and pray that everything will recover. So I think the best conclusion of what's going to happen actually came in the Maple Tree Pan Asia Trust annual report, and I think this is a very truthful and honest review. That even with potential rate cuts by the Fed, there will be some inherent delay before we can observe an inflection point for financing costs. Right, swift and more significant rate cuts will be necessary to counter the higher cost of replacing the older fixed rate swaps, debts, and IRSs. So even if the Fed cut rates this year in September or November, it's not likely to cut the really aggressively, really fast. So no matter what happens, I think higher interest rates will trickle into the rest of 2024 and 2025 and 2026. And that will have quite a significant impact on the refinancing cost of the REITs. So there will be quite a decent hit on the DPUs, especially if the REIT is not able to top up DPU with capital returns through the divestment of assets. So that's something that everyone have to watch. Nonetheless, I think regardless what happens, because the major calendar event for the rest of the year will just be the US elections between Biden and Trump. And looking at the debate which occurred last week, I'm convinced that no matter what happens, it still be the same old nonsense. Right? US fiscal recklessness is set to continue. If Biden gets elected, which I don't think is gonna happen because he looks really old and just too feeble, I think, to continue as president. If he continues, there will be more of the same old nonsense, the Green Deal and all those pork uh, policies. And if Trump comes to power, I think it'll be the same thing as well. More tax cuts, more money thrown in, and this U.S. Fiscal recklessness will just continue, which will then lead to even more sustained inflation and forcing rates to stay very very long for a very long time. And I think this is also reflected in the decision of myself to cut REITs to just 38% of portfolio now. So if you recall earlier this year, REITs was around 50% of portfolio. So I've already reduced it by 12% already. And with the continuing return of capital through dividends, I think this percentage will continue to go down. And I will be very happy to have this portfolio percentage go down. And I reinvest the capital into elsewhere, stuff with more cash, no debt, with a higher return of equity compared to the cost of capital. So this is the update of my portfolio. Unfortunately, not much good news to share with all of you guys, but just a very frank assessment of what I think is going to happen ahead. And as for how you want to reposition your portfolio, you can have a very good think about it. Alright, that's it for this portfolio review. Bye bye.